what's going on, guys? Wanted to jump back on here, give you the April market update. It's all gone. April is gone. On to May. It's May 1st, actually, as I'm recording this. April was a great month. A lot of fun stuff took place. I actually got to go watch the Masters golf tournament. Kind of a once-in-a-lifetime opportunity, it seemed like. So had to jump on it. We flew out late Thursday night, caught Friday's round. It was such an amazing, beautiful course. So cool to see all those guys. I was there the round, if you guys followed it at all, that the trees fell down. That part was really scary. I figured those trees killed 2 or 3 people easily. I mean, they just came crashing down right in the middle of a big group of people. It was a miracle that nobody got hurt. But a lot of fun stuff that happened. I wanted to jump back on here and just give you a little bit of a market update. What's been going on in terms of the major indexes, a couple of new things that's happening with our models going forward, and then talk a little bit big picture as well. So over the last month here, if we're looking at the chart, we'll talk about First Republic Bank here in a second, but starting with the bond ag index, basically a good indicator of all different types of bonds. It's an ETF here, but down a little less than 1%. The NASDAQ is up 0.38% last month. The S&P 500 is up basically 1.5%, and the Dow Jones leading the way with a 2.3% increase. So nothing really too crazy this last month, but looking year to date, numbers look pretty decent. Tech has really rallied, which I'm going to show you the Callan table of periodic investment returns here in a second, and this is going to make a lot more sense. But Matt, if you remember from last year, we kept talking about how much tech was just getting absolutely just tanked as interest rates kept rising. Tech valuations were falling, investors were panicking, and they were just selling tech left and right. Well, it actually last year, the NASDAQ was down around 33% roughly. Now back up 20% just here over the last 4 months. So it's been absolutely skyrocketing. S&P 500 is up about 9% here. Dow is up 2.7%. The bond ag index is kind of performing like stocks a little bit here, up 2.5% over the last year to date. Which we can kind of expect. If you remember last year, the bond ag index actually had its worst year in history, being down 13% last year. Prior to that, the worst it had ever been was down about roughly 3%. So not super surprised to see a little bit of a rebound here. But one of the biggest things, bigger headlines that's been happening this week, First Republic Bank being bought by JP Morgan. I mean, oh my goodness, these banks, they seem like they're going under left and right now. It was actually the third mid-sized bank to fail in less than 2 months. So it'll be kind of interesting to see what happens. The Federal Reserve is going to have to take this into consideration when they're looking at their rate hikes going forward. I think that this is going to be a deterrent for them in terms of making them want to think that they may raise rates less than earlier anticipated, because that's the last thing they want to do. Of course, we've been talking about this for a year and a half, that they're pumping the metaphorical brakes on the economy. They're trying to slow things down in order to basically stop the train. But in order to stop the train, you can't do it all at once. They're just trying to figure out the perfect amount to do it that it doesn't quite cause a recession. But they don't want to just be having banks fail left and right under their policies either. So they're in kind of a sticky situation. It'll be interesting to see what they do going forward. But First Republic stock went to zero. It's basically worthless as of now. So pretty crazy to see. I mean, I always tell people, you can't lose all your money in the stock market. Relatively, it's impossible, especially with the way that we invest, because as you know, if you're a client of mine, then we use a Corn Satellite model. So most of the money that we are investing for clients is within mutual funds and ETFs. We do take a small portion of the money to buy individual stock positions, more short-term aggressive plays. But it's very rare for a stock to go to a zero balance and be actually worthless. But that's what happened here with First Republic. So remember, you are FDIC insurance covered up to that $250,000 in the bank. So there's no reason to be panicking and running away from major banks. The thing that these smaller regional banks were doing, that your Wells Fargo and your Bank of America and all these big banks, they're not participating in the same actions. And realistically, if you remember, I told you a couple months ago, we have bought some bank stocks. Key Bank, Huntington Bank, and Charles Schwab. We are still very bullish on those. They haven't performed very well over the last 2 months since we bought them, but we're looking at such a short-term window here. We're not worried about it currently. They still have fantastic balance sheets. their business models are so much different than these banks that are going under. And we believe that they're getting overly beaten up just based on all of this negative press that's coming out. So we're going to be holding our individual bank stock positions here for the near term here. Now, something that I really wanted to address was I get this question a lot all the time, but it's come up a little bit more frequent over the last couple of months. And that is talking to people that are sitting on a lot of cash. And they're saying, Hunter, should I wait to invest until the market goes to normal? Or should I just put the money to work now? And the answer to that question always depends on what you want to accomplish with that money, right? If you need to use those funds within the 2 to 3 year window, I never ever suggest that people invest that, no matter how bullish I am on the economy, because things happen. Banks fail, and all of a sudden the market goes down. COVID happens. Wars happen. We can't expect the unexpected over that short of a time period. But if you have a long-term time frame on your investments, the best time to invest was yesterday, and the second best time is now, and I'm going to show you why. So let's look at the Callen table of periodic returns here really quickly. So it's basically, and hopefully you can see this, I'll increase it a little bit. It looks at the returns of 10 different sectors from 2003 up until 2022, the year that just ended. So you can see they're looking at emerging markets, meaning stocks that are outside of the US, small cap stocks, real estate, high yield bonds, large cap, global fixed income. I mean, everything that you can imagine, all different sectors. And if you look at this, there's a lot of sectors of the market that ping pong around. And those are sectors that we know are normally going to be volatile, like emerging markets, right? I mean, in 2003, 2004, 2005, well, actually all the way through 2009, emerging markets really killed it. 2010 and 2011 performed terribly, right? Down 18%. But the interesting thing about this chart, and I know there's a lot of colors here, and you can Google this, look at the Callen periodic table of investment returns. But the moral of the story here is what I always preach to you guys is riding the roller coaster through and not trying to time specific events. Because if we look at emerging markets here, and let's say it was 2016, just for example, you're saying, okay, emerging markets performed great. They were up 11% that year. You're getting excited about, you're buying in. So maybe you buy in 2017. They gained 37% during 2017. Well, 2018, they lost 14%, got crushed that year. So you panic, you freak out, sell it. The following year, they rebound 18% the next 2 years. With all of these different sectors, and if you kind of just follow the pattern of what's happening with all these different colors, a lot of times after their worst performance year, they follow up with a very, very good year. Not always the year right next to it, but within a 2-year window here. So it just talks about that, not timing these events because it's impossible to do. That's why we have to stay long-term diversified with this deal. Now, the crazier part with this is looking at cash. So cash has only been the top performer of asset classes 2 times in 2018 and 2022. Normally, it's kind of down here at the bottom, which makes a lot of sense, right? We all know that you're in your checking and savings account, you're getting like a 0.05% rate of return on your cash. And especially when the market's doing well, obviously that's very unattractive. But 2022 was such a bad year for the markets. Cash was actually the number one place to be. So that just goes back to show how weird of a year it was last year, honestly. And then just kind of playing on that, looking at this page as well, something I want to look at, because everybody, we all know that the market should have a rate of return somewhere between probably an 8 to 12. Most people, say that S&P average is roughly 11% over the long run. So if we're actually looking at a historical period of 97 years, there has only been 6 times ever where the S&P 500 actually had a normal return of 8 to 12%. You actually have a just as good of a chance that the S&P loses more than 20% as you do that it gets a normal return. So when we're talking about these things and I hear people say, I'm just waiting for the market to calm down. I'm waiting for the news to get a little better, to go back to normal. There really never is hardly ever a normal. I mean, the market is volatile. That's just the nature of the beast here. And we can tweak that volatility by adding some bonds and adding some more conservative plays, especially within the core part of our model. But when we're looking at the S&P 500, which is again just US domestic based stocks, there are some very bad negative years and some very big positive years. The crazy thing is when we're looking at how many times the S&P lost 20% or more, there's 6 times here: 1930, 31, 37, 74, 2002, and the most recent being 2008. Well, 5 out of those 6 times that the S&P lost more than 20%, the very next year it gained 20% or more. So in 1937, in 1938, gained 31%. In 2008, then we go look here at 2009, gained 26%. So that's where investors get a little bit messed up. And I'll have to show this picture at some point in time, but there's a really cool picture. And it on one side, it has a bar graph that's really high, and it says investment returns. Next to it, there's a bar graph that's slightly lower, and it says investor returns. And basically the bridge of that gap is just behavior. So when people panic about headlines, they get worried about the next boogeyman that's coming. They're worried about what their friends telling them at the bar that the stock market is going to be tanking, and they panic sell. That's where people get hurt. We can't not allow ourselves to be positioned in a way to take advantage of these up years. That again, it's not an if, it's a when the market's going to perform poorly. It's going to happen. There's going to be negative times, but it has always rebounded. So it just also goes back to, that's why we talk so much about actually building that financial plan, having a good idea about what your specific goals really are, so that we can have, look back historically and keep in mind that volatility is going to happen. It's part of the nature of investing. So when we can plan for it and when you expect it to happen, then we don't worry about it and we don't panic sell. So that's what I got for you guys as of now. Oh, a couple last things. Sorry. We're also going to be within our investment models at Sierra Ridge. We're going to be making a couple changes that you'll see, if you're logging in and check on your account. We're going to be changing our large cap growth fund. So you'll see that coming through. And I talked about this a couple videos ago, but we're also going to be making the trades to extend the duration of our bond plays, meaning that we are not going to have as much exposure to the short end of the yield curve. Currently, we're sitting in a lot of bond funds that we're exposed to, 3 to 6 month bonds, and we're going to move that out a little bit longer. Based on what we believe the Fed's going to be doing with interest rates, we see this as a really, really good buying opportunity. So if you have any more questions about that, I'm happy to talk in much more detail. But with that, guys, that's everything I got. I hope that everyone has a great May coming up. Don't forget to get your Mother's Day presents here soon. And if there's anything that I can do, anything that you need help with, feel free to give me a call at any time. Have a good one, guys. Bye.